It is Friday, August 21st. Here's what's on the agenda. Scott Bessent flags a bigger buyback as bonds give up their gains. Broadcom, meanwhile, ramps up its AI borrowing as Anthropic eyes a record-topping IPO. And European gas hits a 5-month high as the US threatens to take on China over Iran.
OK, let's talk about that gas story, Tom, and talk about kind of where we are with that narrative, because I think it's interesting. So I actually want to start there. If you look at the 5-year chart, you take out what happened with Ukraine and the massive spike we saw surrounding its invasion, you end up with an average over the last 4 years of 38. We're at 64. We've doubled in the last year. This is the inflation narrative that you've got to fold in terms of the energy trade going into winter for Europe. Gold is reacting to the Bessent story and continues to react to the Bessent story. Scott Bessent trying to control the long end of the bond market. Unsuccessfully thus far. Gold is a beneficiary of that. The dollar isn't. Euro Stoxx 50 futures, I end there because there's nothing really to see there. The story this morning, once again, looks like we are going to see a drift sideways in terms of the European equity story. We're up less than 0.1%. There's so many stories, though, kind of interweaving stories, interwoven stories that we need to watch out for this morning. We're going to talk about all of them. And the countdown to the opening trade starts right now.
Anything that happens within a 24-hour period is noise. And, I think that once the market understands that we are focusing on fiscal consolidation and that we are trying to bring the market back into equilibrium in a thinly traded market.
So the US Treasury Secretary, Scott Bessent, going on TV to try to address concerns, of course, after that decision on buybacks from the US Treasury Secretary sent ripples through the global bond markets. Bonds then giving up the gains that came through on the initial moves on the back of that decision. Scott Bessent saying he wants to potentially increase the buybacks. He's emphasising that, talking about fiscal consolidation, and additional details will be coming in the days ahead. He says this was partly about addressing thin liquidity. He wants the markets to return to fundamentals. The fundamentals, though, maybe not something that he wants to delve into too deeply, given the debt pile of the US, concerns about inflation and that competition for capital.
Yes, it's August. Yes, that probably is going to have some sort of effect on the market, but this is, I think, bigger than August. I don't know. How does he get out of it? The obvious solutions to get out of this are raise taxes on wealthy Americans who have... if you think about it...
No mention of that yesterday.
Yeah, you think about kind of the buckets that exist. US corporates, the bucket is full. US wealthy Americans, the bucket is full. US government, the bucket is really empty. Water's got to flow from one to the other, basically.
And they talked about fiscal consolidation yesterday, but nothing is really convincing, right? You're talking about looking at fraud within the government. We saw how well Doge went, so it doesn't seem like that's going to give you a lot of money. And I think the market's really questioning, is it liquidity? Is it fundamentals? Because this came 2 weeks after your refunding announcement at an unusual time when yields were at the highs. And so the signal seems to be yield rather than what's happening with liquidity, especially when you have auctions that are very well covered. The 30-year auction came in at a high, but it was well covered. And so I think the market is saying, we're just not buying it.
Summers appear to me to come around every year. Buybacks from the Treasury don't appear to happen every year. So there's a bit of a disconnect there. The dollar is under pressure again. Gold continues to rise. Bitcoin has had a significant bid as well. So the markets continue to read this to some extent as a shift out of those assets and what this means. Still question marks about what it means for the Fed as well. If they do succeed in getting yields down, does that actually force the Fed to have to think about hiking rates when it won't and doesn't want to necessarily?
I'm really interested to hear from what the Fed has to say. The Americans have a bunch of choices. They can either kind of accept high yields, they can accept higher taxes, or they can accept a lower dollar. My bet is, and this is Kit Dukes' line, is they'll accept a weaker dollar, and that seems to be the kind of the result of all of this. The competition for capital, we've been talking about it a great deal. Broadcom is now adding to that competition for capital. Looks like it's going to be looking to raise between 60 and 100 billion. It's going to be backed by Blackstone and Apollo as well, but Broadcom's going to secure the kind of the senior element of all of this. This comes back to this whole idea that you can treat chips as infrastructure as well, which I think is an interesting narrative that I think is probably worth exploring. But it basically comes down to the narrative that you fit these two stories together, there is a competition for capital. You've got the government on one hand, you've got the AI build-out on the other side. It's interesting that this obviously relates into Anthropic as well, because this is going to be a big part of the kind of Anthropic story. This vehicle is basically designed to keep this debt off the Anthropic balance sheet, because we're going into an Anthropic IPO, which is another competition for capital as well. And then you look at Samsung, which is going to be returning money to shareholders. So the capital's kind of doing a nice little loop and going through the system and basically coming out for Samsung shareholders. It all seems to fit together quite neatly to me.
And the question is very much, where do investors want to put their money, right? We're seeing maybe crediting out equity. And I think, too, if you look at the R minus G equation for AI credit, that's much better than the R minus G equation for U.S. government bonds. Yeah. And so why wouldn't you look there? And these IPOs are much more massive than anything we've had in history in terms of companies are staying private for longer and then coming. So you're going to see more churn in the market when they do eventually come, because people are repositioning into these big allocations.
SpaceX ultimately ended up raising more than $80 billion in their IPO. It was, of course, a record IPO, and Anthropic are looking to either match that or top that. And potentially by the end of this month.
Yeah.
I mean, there had been expectations it would land sometime in potentially September, October. The Bloomberg reporting suggesting it could come before that. Does that suggest they want to get out of the gates before things start to close up again? What does it mean for OpenAI? They're still slated to list, in fact, in 2027. And we just throw out these numbers. We're becoming used to saying 60 billion or 500 billion, which is the roundup from NVIDIA. But these are massive numbers still.
Two things made me laugh when I read this story this morning. One of which is that they are clearly rushing to get this done because something is coming and they're worried about that. And the other one is there's clearly some massive egos here. We are going to beat SpaceX. We are going to be bigger than SpaceX. Oh, my Lord. That's where we are right now.
Yeah. And I mean, you're getting these IPOs, and the story within the U.S. is that your AI growth is dominating what you're seeing from downside in energy. But certainly in the last week, European equities have been under more pressure, potentially as oil has risen. We got another leg up higher yesterday. And I think the question is really, what is the U.S. actually going to do? Bessent has said that he's going to do a press conference on Monday announcing these economic sanctions. Will that bring in China? Potentially. We're also seeing pressure from the other side in terms of Ukraine bombing facilities in Russia, putting more pressure on the energy complex generally. And as you said at the beginning of this, gas prices in Europe are at 5-year highs, and European gas storage levels are at record lows for this time of year. So does that get more concerning as we head into winter?
I remember talking about the story a year ago, basically being kind of trying to work out whether or not we were going to be full going into winter, and it was all okay in the end. But this year feels different.
We're at 60, 61, 62%, which again, to Skylar's point, seasonally is that a record low? It's incredibly low for at this time of the year. You're normally filling up to 90%.
So if you don't fill up, you've got to rely on the spot market. And that's going to get interesting because the competition there is going to be significant once again with the Chinese. The Asian consumers are going to be a big factor in that. Who ultimately will lose out on that, I think, will be another interesting story.
South Korea just signed a big contract for gas.
Precisely. The US could be a beneficiary of all of this. But if you look at the 5-year chart, I'm sure we've got it somewhere, you got this massive spike around Ukraine. Prices go up hugely and then they come down. But if you exclude that spike and look at a 4-year chart, the average price is 38. We're now at 65. We are way above where we've been in recent memory, and consumers are going to struggle. And you can see that in the consumer data. You see it in the Walmart numbers. The Walmart numbers are telling you, and they told us this yesterday, gasoline prices are high. That is impacting the consumer. And I think you're going to see that in Europe this year as well.
Can I just briefly re-emphasise, if Bessent and if Trump really do take on China's banks, we have a major problem, additional problem for this global economy in terms of how China reacts. Rare earths, other trade measures, that is another risk on the docket for these markets.
OK, Ronan O'Connell's going to be joining us shortly. Sonex market analyst head. We're going to be talking about gold. We'll talk about what the implications of all of this is. Salman Ahmed is going to be joining us from Fidelity a little bit later on. And Arsenio Dominguez, the International Maritime Organization Secretary General, is going to be joining us. We'll talk about the shipping story. There was an interesting letter just published by 8 of the world's largest maritime associations, basically telling him we need legal action to make sure we don't see the Strait of Hormuz being closed. I'm curious to see how he's going to react to that. Tim Richards, the View Entertainment CEO, is going to be joining us. Did you go to the cinema this summer? everybody else did, apparently. We'll talk about that.
Here's what else we're watching throughout this Friday. From 9 a.m. UK time, we're going to get European flash PMIs. We will break those for you. 2:45 p.m. UK time, we'll get US flash PMIs. We'll be across that data, of course, as well. And at 3 p.m. UK time, European consumer confidence. Confidence here in the UK seems to be rebounding a little bit when it comes to the consumer. And the Bloomberg NEF Summit takes place in New Delhi. Its theme is the future of energy and mobility.
OK, that's well timed. OK, coming up, M&A action in Italy as lender Monte Paschi offers to buy Banco BPM and Banco Generali in all-share deals. That's a defensive move to push away Intesa. So we're going to talk about that and talk about what that means for Italian and European banking. China and Switzerland strike a trade deal which removes almost all tariffs on Swiss exports. We're going to talk about the details of that as well. And Florian Aleppo is going to be joining us, macro research head over at Lombard Odier Investment Managers. I'm looking forward to hearing what he has to say. If you have any questions, if you want to join in the conversation, we'd love to hear from you this Friday morning. IB Plus BBTV Go is the function. This is Bloomberg.
Welcome back. Happy Friday. We are a little over 45 minutes from the opening trade this Friday. European futures currently pointing up just by 0.1%. We've seen this picture before. We've had 7 straight days of losses right now for European stocks. And if we get another down day, we are set for the longest losing streak since about 2016 for European stocks. Let's focus now on tech and the AI trade and how it links to what we're seeing in the Treasury market, of course, that competition for capital. Bloomberg understands Broadcom is seeking to raise more than $60 billion in debt for an AI chip financing deal that will benefit Anthropic and other companies. Let's bring in Bloomberg's Anthony Stevens. Anthony, what's your take on this planned raise by Broadcom, this financing package, and how comfortable you are with it? How comfortable do you think the markets will be with this?
Yeah, they're getting into the same game as NVIDIA, right? They're helping their customers by putting their balance sheet on the line to backstop debt that is then going to be used to buy data center products from the likes of Anthropic and so on. So again, you have this partnership with the private equity crew. So in this case, Blackstone and Apollo to bring this debt to market, right? What's very interesting around this is the kind of structuring of it. There's a junior and senior tranche, which together might actually hit $100 billion if the capacity is there. Now, last time Broadcom did this, the senior tranche went up at IG levels. So there is a lot of demand for IG level AI debt. You see US hyperscaler debt trade quite well. Spreads are quite tight. And that's why these macro concerns around the long end are important to the AI trade. Now, that being said, CDS investors are a little bit more nervous because they've been viewing these names as absolutely safe credit, right? Cash flow gushers. And now they're moving from being cash flow gushers into the banker of last resort for the AI trade. Now, that's not something the CDS holders signed up for initially. So there is a repricing in the CDS market. Still, stress levels are, relatively speaking, quite low, but they've changed materially. Now, what are the terms going to be for these loans? And with the private equity players involved, and they've also been struggling recently, it'll be interesting to see how the US financial ecosystem comes together to start pricing this debt. Interestingly, the market for compute is about to get a live ticker soon, right? Remember, at the end of the year, we're going to have futures on compute coming through.
We're also getting more equity issuance. Now, SpaceX had a record IPO, and Anthropic says that it can match or surpass that. What are the market implications?
Well, first, we're getting a validation that huge IPOs can come to market without anybody making any money, right, on a net income basis. So you had all those worries about SpaceX and their profitability, and then they launched this huge 1.7, 1.8 trillion valuation company, right? And that's the kind of number that Anthropic is going for. Now, they have a lot of momentum around them in the revenue side of things, right? The ARR was a huge bump at around 65 yards for this year, which is a huge increase of last year. But while they are mildly net adjusted income positive, last year they lost $40 billion, right? So in terms of setting up the new valuation metrics for this space, this is going to be such an important IPO, and whether they can get it off at this valuation is going to be super interesting. They've added Citibank to the list of banks that are working on this IPO. Citibank obviously worked on SpaceX and is leading the US IPO league tables. It's also interesting that as recently as May, they did raise private capital at around $965 million. So 1 to 2 trillion is not in the realm of fantasy for this stock, but it does involve this stock fading this threat of Chinese LLM competition, right? Remember, the Chinese are making the same amount of progress at a much lower pricing point, and a lot of these companies that are listed in Hong Kong, for example, Jerpo and Minimax, trade at a tiny fraction of this valuation.
And then can Anthropic stay above its IPO price, I guess, would be a key question going forward from there. Anthony, fantastic. Thank you very much indeed. Anthony Stevens, on what we're seeing in the market this morning. Florian Ielpo is the head of macro research at Lombard Odier and joins us now. Florian, there's a competition for capital. You've got the AI trade on one side, big issuance coming through both on the debt and the equity side. And then you've got the US government, governments globally fighting also in terms of trying to access that capital. Who do you think is going to win here? Do you think there are going to be any winners?
Oh, it's difficult to say if there will be any winner to it. Basically, debt comes with a cost, and the issue we're having those days is that cost is rising for a multiplicity of factors, meaning there is this competition between basically corporates, global corporates, and government on one side. But you also have this mechanical adjustment of better economic situation involves better expected return on the equity side, and that needs to be repriced also in your yield curve because you need to keep your bonds attractive compared to equities. So basically, you have a flurry of factors that combine together that are explaining this increase in the cost of capital. Now, the question is, what are the in the here and now? What are the consequences, and maybe in the future, can these break the cycle in which we are at the moment? That's the key question of the day.
And what's the answer?
The answer is that for now, what seems to be dominating is the repricing of the improved perspectives on equities, meaning real rates basically are rising in tandem with profit perspectives, earnings perspectives, and then equities perspectives. This is pretty sound as an evolution, right? We're no longer relying on quantitative easing. We are not really relying on fiscal policy. Actually, what we're just seeing the repricing of is something that looks like what we had in the 90s, meaning decent growth or strong growth even, leading to overall majority of asset classes providing us with very attractive perspective. It's an industrial revolution with a surge in productivity. This is very good for equities. And in the meantime, the long-term prospect of the bond market are now looking excellent. Think of yourself as an insurance company. Think of yourself as a long-run pension scheme. Well, the bond opportunity hasn't been so great in 30 years, maybe.
How dependent is that view on inflation heading in a continued downward trajectory, Florian?
That's exactly that. Meaning, real rates is something that normally the economy can absorb, and even that evolves in a proportionate way to the rest of the economy. Now, inflation, that layer on top, that can derail everything. There is a vast uncertainty at the moment in the case of inflation. The one thing I would say is that take a peek at what's happening in terms of wage growth globally and especially in the US, because over the longer run, inflation equals the growth rate of wages. And that growth rate at the moment appears to be very limited. So there's been a decline in the cost of labor, to say it in another way. And this combines very well with what's happening in terms of productivity growth. All of that is normally pushing for less inflation rather than more inflation.
I do wonder then if we're having these series of supply shocks through the 2020s, which don't seem to be going away given the geopolitical backdrop, how do you insulate a portfolio given bonds and equities both come under pressure when inflation rises?
They're the short-term perspective and the longer-term perspective. The longer-term perspective is excellent. Long-run prospects of an industrial revolution usually leads to strong return on equity side, and with the level of yields we have now, holding bonds for the next 10 years makes a lot of sense. Now, how do you work around the current short-term risks? Well, cash is an excellent option, but also think of the perspective of the broadening of the cycle we're currently faced with, meaning value is usually the kind of factor that does pretty well when rates are elevated, but the growth momentum is strong. And we're probably in this kind of environment. So there are plenty of opportunities at the moment to improve the diversification away from the duration risk that seems to be scaring the market at the moment.
I do wonder, focusing more on the near term, we've had the buyback announcement earlier this week. It's flattened the curve. Are there any kind of unintended consequences of that feed into either sectors or other parts of your fixed income view?
It's a fair question. I would say first that the Treasury is not the Fed, meaning the firepower of the Treasury is much more limited than the Fed itself. The Fed is excellent at controlling the yield curve. The Treasury, basically, it's an experience. It's an experiment. And the firepower at disposal, even if it's doubled every day, doesn't change much actually. When you repurchase a bond, then you need to borrow money short and in the short run, and this can come in conflict with actually the objective of the Fed to control inflation. If we have hikes, then we can see a flattening of the curve, and then the opportunity of these twists operated by the Treasury comes in. The benefit of it are much more limited, I would say. So this is an interesting signal. Maybe that should give some comfort to bondholder that maybe the longer-term perspective, the good longer-term perspective, are maybe more in the medium term than in the longer-run term itself.
Okay, Florian, thank you very much indeed for your insights this Friday morning. Florian Idialpo, Head of Macro Research at Lombard Odier.
Okay, what else do you need to know this Friday morning? China and Switzerland have agreed a trade deal that removes almost all tariffs on Swiss exports. The Swiss government says its investors will also get better access to the Chinese market. The deal offers Switzerland some relief amid the continued risks from US tariffs. France's fiscal deficit would widen by at least 0.5% of GDP if political divisions prevent the adoption of a 2027 budget before presidential elections. The state's finance auditing body says rolling over previous measures would rattle investor confidence and limit the government's ability to control social spending and raise new taxes. And British consumers are more confident than at any point since Labour took power 2 years ago. That's according to a GfK survey, which found all sentiment indicators improved in August. Household views of their personal finances climbed further into positive territory, with intentions to make major purchases at their highest level since 2021. Aggregate demand about to get a decent boost coming through. But at the same time, you've got government finances again in trouble. You've got to look at the deficit data we've seen this morning. Like, how much is that going to constrain
1.8 billion,
yeah,
so 1.8 billion pounds, the most recent deficit data.
It was expected to be flat. Yeah, the government's borrowing. Another
it comes
government
in close
borrowing.
to 2 billion.
And we've got a budget coming up in October where how do you actually ease fiscal conditions? I don't think you really can. And at the same time that we've gotten this data, we've gotten retail sales. And yes, they were for a month earlier, but they were very negative. And so maybe consumers are feeling better, but they're not spending.
Yeah, and why are they not spending, I guess, is the big question. There's a lot of volatility. We've seen huge amounts of volatility in the UK economy. Consumers really for a long time now have basically retrenched because they're worried about the economic volatility they see in front of them, supply shocks, what's happening with inflation, all of these kinds of factors generally, like in theory they shouldn't, but they do cause inflation. They do cause consumers to retrench and save. So you've got the savings rate.
Coming up, we're going to look at what is happening in terms of precious metals, and this is partly down to what we've been hearing from Scott Bessent. Gold on track for its third week of gains. We're going to discuss the latest bullion moves with StoneX's Rona O'Connell. That is coming up. This is Bloomberg.
Friday the 21st, good morning, half past the hour. Let's talk about where we are with the futures picture going into the market open this morning. Flat is the best way of describing it, as you can see. If we don't finish higher today and we finish lower, we are basically in a position where we have seen the worst run of form for the European earnings story, the European equity story in 10 years. So basically, we haven't seen this kind of run since 2016. Now, it is August. I'm just going to kind of put it out there. And the moves are not significant. But nevertheless, it's not exactly a great precedent.
Let's turn to the bond markets then, because there's not much news there right now. I mean, of course, there has been that reaction to what's going on stateside in terms of the Treasury decision on those buybacks. Treasuries have given up most of their gains. Here in Europe, you're flat, stable so far in the session today. 325 on the German benchmark. You're seeing still holding above 4% in both France on the 10-year OET and BTPs at 4.06. But again, stability at least so far in sovereign debt markets. We're getting macro data in terms of PMIs through the next couple of hours. So that may change what we're seeing in the bond markets. We will see. Of course, the movements towards the long end and the sell-off that we've seen turning, at least having some impact in the precious metals market. Gold set for a third weekly gain after the US Treasury's unexpected ramp up in buybacks and long-dated bonds. Gold having a good session today as well. Joining us now is Rona O'Connell, market analysis head at StoneX. Rona, good morning. If this is financial suppression from the US Treasury Secretary, how much further does gold have to run? To what extent is this already priced in, or is there further upside as investors digest how the Treasury is trying to manage yields?
Good morning. The Treasury announcement certainly saw a knee-jerk reaction pretty much across the board in the precious metal sector, and to some extent, although lesser in the base metals. Partly partly dollar-driven, because obviously the dollar went onto the back foot. But the sentiment in the gold market has been improving gradually over the last 3 weeks or so. And if we look at the managed money participants positioning on the COMEX and the activity in the exchange traded funds as tangible proxies for what's happening in the over-the-counter market, then we do have sort of hard evidence that sentiment has been improving basically through most of August and back into early July. So when that announcement came through midweek, the market was already set fair for further gains, and it took it well, obviously. So we're now trading at just over $4,550 an ounce. The high, just to remind everyone, was just over 5,500 at the end of January. But that was a very crowded trade. That was driven ultimately by momentum and technicals and all the different elements that kick in when a market has got the fire underneath its feet. This time around, it's more measured. And therefore, while the high in January was not sustainable by any stretch of the imagination, this activity could well go further because it's coming at a reasonably decent pace, and it's not frenetic. It's quite orderly. The physical market is still pretty slow. This has been driven by the professionals, but short-term moves always are driven by the professionals. And it's not so much a question of the dollar on its own. There's geopolitical risks still in there. The Gulf is still in the background. And the announcement on Wednesday, if anything, threw a little bit of uncertainty into the markets in terms of financial activity coming out of the government in the United States, and it's uncertainty which is probably the key driver in this latest strength.
OK, so there could be further to go. If we were to get a more hawkish sounding Fed, would it derail the run for gold?
It would certainly take some of the heat out of it. I'm not a technical analyst, but looking at some of the key technical features which are easy for a fundamentalist to understand, it's in overbought territory and it needs to come back and take a little bit of a breather. If and when we do see the end of the family fight that Kevin Walsh has been looking for, and he's certainly got it, on a hawkish basis, it would definitely take some of the wind out of gold sales. At the moment, the Fed is bifurcated, and that's also helping because the market's not quite sure what's going to happen next from that side of things. Bear in mind also that the announcement from Mr. Bessent on Wednesday, that's the Treasury, it's not the Fed. And $2 billion pales into insignificance by comparison with what the Fed is capable of and what it has been doing, which is in hundreds of billions over the past few months, and certainly going back years, back to GFC.
Gold did very poorly on the initial U.S.-Iran conflict. So I'm wondering, is it only a good hedge now for certain political risk, or is it certain circumstances like being very overbought that make it more vulnerable?
Generally speaking, you're absolutely right. It's hedge against risk. The inflation argument generally takes a back seat. It's much more concerned with what's happening in the bond markets, which of course is all tied in with inflationary expectations. But for the time being, geopolitical risk in terms of the Gulf is largely sidelined. Now we're concentrating much more on what's happening with respect to financial management. And for the time being, while there's uncertainty over the direction of travel from not just the States, but predominantly so, then there is still some tailwind. We're in overbought territory. The next resistance level is around about 4,600, which is not actually that far away. It is time for the market to take a breather, though.
Rona, are central banks still buying? What's the central bank story?
Central banks are mixed. The Russians, there's a headline from Bloomberg this morning that Russia has let a little bit more go. Now, that's understandable because the Russian central bank has been quite open about its policies and has been for some years now. What they wanted to do was to reach a stage whereby gold stood at 20% of gold plus foreign exchange combined. It reached that something like 18 months or so ago, and with what's been happening in prices since, they've been tweaking to by the looks of it, to maintain that 20% level. There is buying coming through again from quite a few of the Russian satellite states. That's where a lot of the momentum has been coming from over the past 2 years or so. Poland's been a buyer. The story about Venezuela, with respect to wanting repatriation from London back into Caracas, that's very much a legal issue. It hit the headlines, so it might be worth looking at that just for a second or so. The United States and the Venezuelan government and opposition have all been talking over the last few months or so with a view to asking for repatriation of the gold. That can't happen at the moment because the Bank of England's hands are tied. It's not a Bank of England decision. Unless and until the United Kingdom recognises the current administration in Venezuela, then the gold has to stay where it is. So that's something that's bubbling along and behind the scenes. But on balance, the official sector is still a net buyer, and it's all to do with mitigating risk and to some extent diversifying against the dollar.
Rona, thanks for catching us up. Really appreciate it. Rona O'Connell, markets analyst, joining us from StoneX, market analysis head, joining us from StoneX. Let's switch from one commodity to another commodity. Oil is heading for a substantial weekly gain as the US ups its push to isolate the Iranian economy. The Trump administration is preparing to unveil new measures. We think that now comes on Monday. Bloomberg Horizons anchor Abu Omar joining us now. What do we know about what we're going to get? We think it's going to come on Monday. What impact could it have?
Good morning, Guy. Well, we'll know more on Monday, but this is essentially Scott Bessent saying to CNBC that this economic isolation plan that the U.S. has been touting over the past couple of weeks or so, the details on that are going to come on Monday. He did say that countries are going to either be with the United States or against it. So we have reason to believe that this is going to be, as opposed to sanctions against Iran, perhaps some secondary measures against countries that continue to do trade with Iran, Guy. And you saw that in the shape of what the UAE had said over the past couple of days, saying that it's cut all financial and trade ties, transactions essentially with Iran. And so we believe that this could be just some secondary sanctions on any country that decides to do further essentially trade with Iran. From the Iranian side, however, They rejected this economic isolation plan. They said that it would be a failed policy. This is, of course, the foreign minister, Abbas Araghchi, saying that further failed policies such as these economic isolation measures are really not going to have an impact on Iran. Let's just bear in mind that Iran is the most sanctioned country by the United States, and its oil has been sanctioned for a while. And then again, our Bloomberg economics team have put out a report earlier saying that the policies that the U.S. had taken over the past 5 decades or so, more or less of these sanctions are really not going to have a very big monumental impact on Iran going forward. But this is all premature because we still need to hear just what exactly the U.S. is planning. And as you said, that will be coming out on Monday, of course.
I think a part of this that's very much in focus is China, given their import of quite a lot of Iranian oil. Will this escalate tensions between the U.S. and China?
Yeah, Skylar, I mean, you're right. And Iran sells 90% of its oil to China, and that is still the case. So it's not clear yet how much leverage the U.S. would have over a country like China, especially with previous tariff wars that have gone on, and whether, the question of whether that will be brought up once again, and with that pending visit of Xi Jinping over in the United States next month. Now, for what it's worth, the United States did sanction some independent refineries at the start of this war in February. Those refineries, of course, Chinese-flagged refineries, but it fell short from sanctioning banks that were in charge of such transactions. And so we're not essentially very sure about how the United States would go further with sanctioning China, or whether that will actually be fruitful to its wider trade goals. Yet again, another question that we will have to wait for to be answered on Monday. But for now, you're seeing what energy prices are doing, and Brent is moving lower, although it is set for a weekly gain, of course. And that is because, I guess, investors are just bracing for what exactly this newest plan by the Trump administration will indicate.
Abir, great stuff. Thank you for the updates. Abir Omar joining us out of Dubai on the latest when it comes to the oil market and the geopolitics that surround it. So Bill Dudley used to run the New York Fed, so he probably knows a little bit about how markets function. He's a little worried about the stock market.
Look, the railroads and the internet, telecom boom, all those things did great things for the economy. So 2 things can be true at the same time. The technological innovation can be really transformative. But at the same time, you can have an investment boom and bust. And in fact, if you look at history, it tells you that that's usually the case. So the question here is really just really not whether it's going to be a turn from a boom to a bust. It's really a question of timing and magnitude.
Bill Dudley, former New York Fed president, now Bloomberg columnist. Where do stocks go next? We're going to find out next. This is Bloomberg.
Two aspects there. One, is it like a sudden snap? Or two, is it just slow wear and tear or something along those lines? And I think that the latter is something that markets can show more resilience against, right? So but we're still finding out what kind of material that the market is made of.
We've had this, 3 or 4 years of increased fiscal spend globally. And now we've kind of compounded that with sort of hyperscaler issuance and sort of the AI CapEx story. And both of these dynamics in the market are very big sources and have very, very big needs for global capital.
I don't think there's a set yield in the AI sector. What we need for quality growth is those yields to stabilize in some way. I don't think it tests the AI thesis, but it does test the allocation of capital and what that means for portfolio construction. We are talking about that more than we ever needed to before.
The latest numbers that we've seen is that they're getting the return on this investment, and CapEx is accelerating. And I wouldn't expect, therefore, to see a moderation in that CapEx, but it's just the sustainability of continuing to impress with the earnings performance and the margins.
We also have to have a conversation around what does sustainable really mean. CapEx from the hyperscalers increase, what's expected to be 77% this year on top of a similar magnitude last year. Sustained could just mean, maintaining that high level, not necessarily that really robust growth rate.
Just on the show, talking about the story of competition for capital that we are seeing. Debt issuance from the hyperscalers, debt issuance from governments colliding in so many ways and forcing yields higher, like a sort of tectonic plate colliding into another tectonic plate. That's what it feels like this week. Today's Markets in 3 Minutes is with Mr. Mark Cudmore. He joins us now, Markets Live executive editor. Mark, in terms of the casualties of this collision of tectonic plates, it feels like the dollar is actually one of the biggest casualties. And the famous Connolly phrase, our currency, your problem, feels like it's reversing it a little bit. Your currency, your problem.
I think that's absolutely true. The dollar will be the long-term sustainable victim of the various interventions in policy by the US Treasury recently, combined with the new approach from the FOMC. And I think, this is in the backdrop that, we had a big dollar depreciation trend last year. It's kind of paused for about the last, I guess we had it the first half of last year. It's paused for about a year now. I think we're now into the next big leg of that long-term downtrend in the dollar. The dollar is still an expensive currency, and I no longer feels like it offers the attractiveness or the edge to justify that, particularly when you've got policy that's been implemented that seems on the fly. We expected Scott Bessent to be kind of the adult in the room when it came to policy, and I feel that impression has been very much undermined by some of the recent moves.
So the dollar's back under pressure. That's financial conditions easing. Is that just good for assets globally? It
is at its core. I mean, sorry, I shouldn't sound so tentative there. It definitely is at the headline level. It is an easier financial conditions, and of course, you have many other assets that are just are measured in terms of the dollar. So therefore, you see dollar weakness. You're going to see gold do well. You're going to see Bitcoin do well. You're going to see alternatives to the dollar. You're seeing the world's reserve currency weaken. That means people want to go back out into real assets and alternative assets. So it is good for other assets. Now, the reason I kind of paused a little bit initially was because obviously, if this happens because there's such an undermining of policy credibility that yields in the US start surging, well, that's going to be such a risk aversion event that you're probably ultimately going to see the dollar much, much weaker again. But it's going to go in waves of kind of bouts of strength as we kind of get deleveraging to back into people selling when they've been cleaned out. So it'll be an extremely hard trade to have. But I think yes, absolutely, the dollar downtrend longer term is sustainable.
Mark, how concerned are you that they really go hard on China when it comes to Iran with this plan set to be unveiled on Monday?
You know what? Not overly concerned in terms of that. Look, we've got to wait to see what's announced. We know that the general story of this administration over the last 18, 20 months has generally been a bark that's worse than its bite. And we have to see how much they're willing to kind of escalate to kind of traumatize markets again in the midterms. You've got to remember that the whole reason that we're going down this sanctions approach as opposed to the military approach is so that we don't disrupt markets anymore before the midterms. So it really kind of undermine that whole policy path if they then cause such disruption in markets by taking such a hard angle that upsets China greatly. So I don't think that's going to be a big risk event next week. It might be one in the short term, but I would suspect that by the end of the week, we've moved on to that. And of course, we'll then be focusing on Jackson Hole and wearing our cowboy hats.
OK, Bloomberg Markets Live executive editor Mark Cudmore. Mark, have a great weekend. Thank you, of course, for your analysis through this week. Remember, you can get up-to-date insights and analysis from Mark and the rest of the team. Just go to MLive Go on your terminal. Let's get your stocks to watch this Friday. Alex Morgan with the details. Alex.
Good morning, Tom. Happy Friday. Yeah, well, they say sometimes that attack is the best form of defence. And in the latest chapter, the latest twist in Italian banking M&A, that is what we have got this morning as Banco Monte Paschi is seeking now to take over two other banks in a bid to fend off that takeover offer from Intesa. Now, you can see here are the performers through the year, the key names there in the Italian banking picture, and it is a bit of a tangled picture. This is the CEO, Luigi Lualio, seeking to make Monte Paschi too big to swallow for rival Intesa. Let's flip the board and have a look at how this offer, this all-shares offer for two rivals is being described this morning by analyst Nicholas Mamarek, saying that it's not just sort of, an offensive move. It is a defensive move here, and it's basically saying it's a move anybody but Intesa. Now, for this to go through, this all-shares attempt to take over Banco BPM, Remember, there was that attempted merger of equals that didn't quite work out. And Banco Generali. For this to go through, there needs to be the approval of shareholders, a meeting at the end of October. So it is the latest chapter in a saga with a lot of names and a lot of twists. But banking, M&A, Italian banks on the agenda this morning. Let's flick it over to Societe Generale. And here we've had a downgrade this morning, a cut to underperform at KBW. And this is sort of looking at the underperformance of Societe Generale compared to US peers, but also looking at some of the domestic pressures in France weighing, the political pressures weighing on the domestic side. Interestingly, though, for Societe Generale, looking ahead to that rebalancing of the Euro Stoxx 50, potentially a tailwind coming down the line. But Societe Generale also on our agenda this morning. And finally, let's finish with Renault. Renault this morning cut to equal rates at Barclays. And yeah, this is the ongoing picture. Look at these European car makers here. You've got them alongside Volvo, Volkswagen. They're struggling. And I think if there's one word that sums that up, it's China. China, the sales, of course, there's squeeze on sales in China and then the arrival of Chinese EVs into the European market. We know that Beijing is eyeing expansion over here. So you can see those pressures. Renault dealing with those pressures, and I think that's probably reflected in that cut this morning. So some of the stocks we're going to keep our eyes on when trading gets underway very shortly.
Alex Morgan, thank you very much indeed. We'll be watching tech as well on the back of what we're seeing stateside around Broadcom and its additional capital raise, or at least debt raise. That is the plan, and Anthropic's plan around IPOs. I know Guy Johnson is worried about the deficit here in the UK. We've got the budget coming up as well, further pressure on the Chancellor Healey. And, yeah, the Italian banking space is going to be pretty interesting. Some of those names, some of those potential takeover targets called higher this morning.
Absolutely. That budget story is going to be really interesting going into the gilt open this morning. The UK government wasn't meant to do this at this stage. We're getting negative numbers. We're not meant to be getting negative numbers. The pressure on the government, Burnham, to do something about this has got to be great. You've got to look at what's happening in the States.
And I do wonder if the market gives them the leeway to give you a plan first before deciding.
We will watch with interest to see the market reaction. You've also had retail sales, which actually the retail consumer confidence and retail sales that look okay at the moment. Don't look at the sneaker market, though. Apparently that's where you don't want to be looking. Anyway, the opening trade is next. This is Bloomberg. Couple of minutes to go. Friday's session is almost upon us. Let's talk about where we finished in Europe yesterday and where we finished in the United States. Stock 600 was down by 0.81 in terms of the point story yesterday. We were negative, another negative session. We get another one today. And you are looking at the longest losing run you've seen for European equities since 2016, 10 years ago. So just bear that in mind when you look at the numbers that you're going to be watching today. This was the session yesterday for the S&P. We went out here, we finished down there. That's a fairly negative tailwind coming through for the European story this morning. And as a result of which we have a flat open expected once again here in Europe. We've started flat over the last few sessions but finished down. Not by much, but a little bit, and that seems to be the ongoing narrative. Now, it is August and volumes are epically light, so just bear that in mind when you think about the kind of historical narrative that we're talking about here. 50 futures down, up by 0.2%. FTSE's absolutely flat, DAX is absolutely flat as well. At a headline level, there's nothing going on. Below the surface, there's a few interesting stories that are percolating. Tom.
Fascinating stories over in Italy when it comes to the banking space. So we'll be watching, of course, Italian lenders on the back of the moves by Monte Paschi to try to shield itself from this takeover offer from Intesa to San Paolo, looking to buy Monte Paschi, potentially two banks, including Banco, BPM, of course, and Generali's bank as well. So watching that set of lenders over in Italy. Holcim, this is a potential takeover story acquiring. It is acquiring part of the European business of James Hardie Industries, expanding its building sustainable flooring. Who doesn't like sustainable flooring? And walling solution offers. And SocGen, this is a story of a downgrade coming through for the French lender, cut to underperform at KBW. So watching SocGen as well, Guy.
Doesn't feel like the ground is very stable underneath the feet of this market right now. So let's talk about what we are getting in terms of this open. Are we going to finish in positive territory today? That is the key number you want to watch out for. The open, though, looks a little bit like this. The FTSE, a little down. Not by much. We're down a little bit, though. In and out of red and green. That seems to be the narrative that we're watching at the moment. At an index level, actually, we're not going very far, but we are kind of, in aggregate, slowly creeping a little bit lower over the last few sessions. SOC 600 opening absolutely flat. FTSE 100 can't make up its mind. CAC 40, there's a few stories worth paying attention to there. The Italian story, though, is going to be interesting. We don't have the Italian market on the board at the moment, but we will look at that in just a moment. AEX, nothing to see here. IBEX is up by 0.3%. The Germans are still to open. We'll see what exactly that market delivers today. But what you are seeing here is a picture of, well, nothing, really, to be honest. You're not seeing a great sense of direction coming through from the European markets this morning. The open's going to be interesting. The close is going to be fascinating, I think, today, to see whether or not we complete that historical run. Biggest losing streak in 10 years, potentially, coming through at the end of this week, Tom.
On a sector basis, there's a bit of interest when it comes to basic resources. We've seen, of course, what's been happening with the gold and silver prices. Strong session again today. Basic resources top of the list in terms of the sector-by-sector breakdown with a gain of a little over 1%. The banking space, of course, in focus around what's happening with Monte de Paschi and its efforts to buy a couple of smaller lenders over in Italy. So watching banks as a sector, that's up 0.3%. On the downside, you've got health currently down 0.4%. Media and energy. Interestingly, energy a little softer by 0.2%. Oil is hovering around that $93 a barrel level. On the tech story, we continue to watch that given what's happening in terms of the funding announcements out of the US. Tech currently in a sector, as a sector here in Europe, just up 0.1%. So that's the picture. Top side, the best gains coming through on a sector basis, basic resources. The biggest losses down 0.8% is healthcare right now, Guy.
Okay. Miners are up a little bit. It's really mixed. There's nothing. There doesn't seem to be an obvious narrative. Some of the defence stocks are a little weaker this morning. So let's take it on to gilts. What are we seeing in gilts this morning?
I mean, not a lot either. In terms of, we've had the data this morning. Consumer confidence was very strong, but retail sales weren't great because people just aren't spending. You had public sector net borrowing come in at an unexpected deficit, which should be quite negative for bonds, but maybe we're just looking forward to the autumn budget. Maybe there's just a lot going on in terms of what's happening globally around yields being pressured higher and what's happening with the oil price as well. And so you're down a little bit on the yield, but nothing big.
Confidence is really important in terms of kind of how demand sort of shape going forward, but I was always told that you want to watch what consumers do, not what they say. It's like the University of Michigan survey in the States, really negative for a really long time, yet consumers in the States generally have looked fairly kind of well recently. But
Walmart was a big drag.
That's what I'm coming to. So Walmart is a really interesting indicator. Yeah. But I also think it's interesting. You look at what is happening in the apparel sector. You look at what's happening in the shoes sector. And over the last few days, you've just seen a series of really kind of negative stories coming through from that sector, which I think is quite an interesting tell on where the consumer feels, what the consumer's feeling right now.
Let's get to the view then of Salman Ahmed, Global Head of Macro and Strategic Asset Allocation at Fidelity International. I was going to start on Scott Bessent, but maybe we start on the consumer, and possibly the two are linked as he tries to keep yields capped. How concerned are you about the US consumer, the UK consumer? Is the consumer sending warning signals at this point?
Well, I think in this cycle, we have deprioritized the consumer somewhat because of the capex stories and the massive impact of those capex trends. That's not to say the consumer is not important, but certainly not the marginal driver of the economic cycle right now. And if something happens to this cycle, it's likely to be coming from the capex itself rather than consumer. And to your point on rates, yes, that is the transmission channel. That's probably the worry because of political reasons as well. Obviously, especially in the US with midterms coming, because the long end, especially with the housing market, and we have seen the bifurcation of the US consumer, that the lower income consumers have been under pressure for some time now. But yes, all this capex and the multiplier effects around it has been the driver of the US economy.
Former New York Fed President Bill Dudley says that this is a bubble and the bubble will burst in 2027. Do you think he's right?
Well, I think there are certain issues which we are discussing in the sense like, are these earnings an illusion of the capex? So where is the ROI? But that's not to say that AI is not a powerful technology. It is a transformational technology. It will reshape industries. But I think, is there a risk of a massive capital misallocation potentially rising? But timing is difficult.
I mean, you say that the AI trade or AI generally is essentially insulating the U.S. economy. Is there a limit to that?
I think the limit comes from two factors we are watching very carefully. The first one is if, I think we were talking about confidence earlier, is the confidence on this capex ongoing capex remains strong, and there are some weaknesses appearing, which is the leveraging which is happening, which is affecting the wider long end as well, or contributing to it. And the other one is, when does the market starts asking for ROI? Where is the genuine ROI of this capex? So that, I think, dynamic itself is powerful, and it is a macro issue, because if it rolls over, it's going to become a macro recession risk for the U.S. economy.
I mean, I do wonder then, is anything safe when the AI trade rolls over, in terms of you get cyclicals coming under pressure, credit is very exposed, even emerging markets are exposed now. So is there anywhere really to hide?
That has been, the most difficult question we have been trying to answer, which is, where do you get diversification, especially given the concentration which is happening in equities. The bond-equity correlation has been positive for some time now, and we have been basically continue to highlight gold. We are negative on dollar from a structural perspective, and commodities more generally, given that this capex is not just only AI. You need defense capex, you need supply chain capex. The low and unreliable world we are in means that everybody is not going to move away from efficiency, and that means more commodity demand. So we have to spread our bets, but this has been very difficult because the correlation between bonds and equities have been positive.
Why don't I just hide in cash? Isn't that the place to be right now?
I think cash has a role, and we do use it for our clients where the preference is there. But the problem is that cash can create a big opportunity cost if you can't time the market properly, right? If equities continue to go up, we have to get involved, and we are constructive on equities. Have been constructive on equities this year, given the story. So you need something which is clearly offsetting that correlation rather than creating it zero.
Should we be worried that profitability, that earnings are as strong as they are? It feels like an anomaly at the moment. I can see why you would get some earnings being boosted by the capex trade, and I can see why the fiscal deficit in the United States would maybe boost that story as well. But the flip side of the fiscal deficit is that taxes are unbelievably low.
Yeah.
In the United States in particular, both for the high-end consumer and also for corporates. You've got a fiscal problem, and at some point you are going to have to resolve that. Now, you either pay higher yields, you take a weaker currency, or you raise taxes. Do you think at some point taxes will go up and that might impact this profitability story? It doesn't feel like a now story, but it might further down the road have a big impact.
I think that's where the political economy of the U.S. is going to be quite important. And we are watching the midterms carefully. Obviously, Democrats, Socialists are starting to win primaries. And one thing which unites them is that nobody wants to cut spending. They want to spend money on different things.
Yeah, they want to spend, but how do they pay for that spending?
So I think that's where, if the political economy is not ready to cut fiscal deficits, then you have to think about financial engineering. And then we saw some example of that over the last few days. Yeah. But ultimately, the main financial engineer here is the Fed. And we have done a lot of work on YCC, yield curve control. Yep. YCC yield curve control was introduced by the US after World War II. It was an incredibly successful program. They locked the yields.
This is where we're going, is it?
Look, if it gets out of hand and you do not have a political economy which responds to it, then the financial engineering is the only mechanism. And it's a reserve currency. And ultimately, to your point, it's going to be dollar which pays the price.
Wow. Yield curve control. Does that leave the US with a credibility problem?
Well, I think credibility obviously is multidimensional. You are seeing it in geopolitics. It will probably, spill over to geoeconomics and domestic economics as well if the policy choices are made. Certain policy choices.
I mean, you've got the Fed saying follow the puck. You've got the Treasury saying here's the puck. I mean, where's the credibility in that policy?
Look, this is a Washington mess. There's no doubt about it, in the sense that the communication was retracted, and a lot of people have been saying that. It's nothing I'm adding which is new. The communication was retracted at a time when fiscal deficits were very wide. The reaction function volatility was introduced at a time when inflation is much higher than target. So there are multiple things which are adding into it. Now, my point is that they have options. The toolkit, where I do agree with Scott Bessent, is this toolkit is strong. It's a reserve currency, and if they make those choices, they can intervene and have a more permanent solution.
Skate to where the puck is. I guess that's probably the kind of the investment theory right now. Salman, great to see you. Nice to see you. Thanks for stopping by. Salman Ahmed, Global Head of Macro and Strategic Asset Allocation, joining us from Fidelity. Call 6 looks like this. Let me just give you a quick idea of what we're watching in terms of the centre of gravity here in Europe. That's the picture. As you can see, defence stocks are down. Tech's actually having a fairly good day. Let's figure out what else we're watching this morning. Alex Morgan is back.
Good morning, Guy. Yes, here we are on Friday. When it comes to the names on the move this morning, Italian banks, there are a few to keep an eye on. Obviously, that headline story, Monte Paschi seeking to take over. Two others to become too large to swallow for rival Intesa. And this is the picture of some of those big names this morning. Monte Paschi up just a little bit. Interestingly, pre-market on Tradegate was down. Banco Generali, one of those they're approaching, slightly down. Banco BPM, another one approached, slightly down. And then, of course, you've got Intesa at the bottom, slightly up. More or less flat, really. But interestingly, slightly different numbers there to what we might have been expecting, having looked at Tradegate this morning. Let's turn it over to Renault. We had that cut this morning as the European automotive manufacturer faces pretty much the same challenges of some of the other big European names, notably from China. Yeah, down around 2% this morning. Perhaps to be expected. There are a lot of headwinds for the European automotive sector. Let's turn to online ticketing. And CTS Eventim reported their results. Now, these were roughly in line, they were in line with expectations. They've stuck by their guidance. But still, we've got them opening down this morning, around 6%. Potentially here, the view might be that there are a lot of pressures on the sector and there needs to be sort of a bit of positive move going forward to keep the wind in the sails. But while coming in line with expectations, Eventim, the ticketing platform, opening down in the red this morning, around 6%. Let's flip over to Hunting, the energy services provider. There was an outlook miss, down around 20% this morning. They provide services to oil and gas firms. Opening in the red after that outlook news this morning. So an interesting picture. I think, though, reflecting what you were saying earlier on, Guy, a bit of an August when it comes to equities in Europe.
Alex Morgan, thank you very much indeed with some of the stocks on the move this Friday. Coming up, French PMI to the macro then. Data set to drop in a couple of minutes. We'll break those for you, of course, and bring you the analysis. That is next. This is Bloomberg.
Welcome back. French PMIs dropping onto the screen, and they don't make particularly pretty reading, if I'm being honest. The services number, which is by far and away the bulk of the economy, is at 48.4. Now, that's down from 49.6. The direction of travel here, this is contraction. This is not a good number. This is a diffusion index. So actually, that's a fairly pessimistic story coming through. We were expecting 49.4, and we got 48.4. That takes the composite number to 48.8, which was expected at 49.5. The manufacturing number was a little stronger at 51.5, but it's not a particularly big part of the French economy, circa 10% in terms of the GDP number for the French economy. So 10% is doing all right. The rest of the economy not doing all right.
I mean, it says that in some cases extreme heat was cited as a reason for lower activity levels, but you also had a weak number in July. And I think generally in France you've seen weaker output, and it's not a great backdrop when you're heading into potentially contentious election next year.
Potentially, yeah. I mean, a contentious election, in 2027, no doubt. For with the political risk on the agenda for France, euro-dollar currently at 116, closing in on 117, just up 0.2%. That's more down to dollar weakness, you would have thought, than this PMI print. But we're going to get more analysis now. Yeah,
the senior principal economist at S&P Global Market Intelligence says this is a frail print. Frail is the word that he uses to describe it. How does Zoe Schneeweiss describe this number? Our Western Europe editor joining us now to talk about this data. Just walk us through the key takeaway here. What are the main takeaways from this number? Disappointing is probably the word I would use.
Exactly. France has been the outlier here. If you look at the rest of the euro area, we're all above that 50 number that delineates growth and contraction. And France just has fallen short time and time again. And this is just quite, as I said, disappointing. And also, if we think back 5 years ago, when Macron stood for re-election, one of the things that we said we had a big story at the time, it's the economy. that's what really, by focusing on the economy, he did have a nice win again. France's economy was doing really well back then. Post-COVID recovery was looking good, and now everything just has come to a standstill, and that's just, again, as you said, disappointing.
We'll get German and Euro area PMIs shortly. What can we expect from them?
So Germany and Euro area both have been surprisingly resilient. Germany's been above that 50 level. We've had just a report from the Bundesbank yesterday, which said that Germany's on the path to recovery. Of course, Germany does have that additional help from those billions and billions of euros that the government is spending on infrastructure and also on defense, which just overall helps lift the economy. And again, Germany, one often says Germany is the engine for Europe, and the euro area also is above that 50 level. And that's also what then allows central bankers to hike rates initially already now in June, and then likely to do so again in September, because while inflation is strong, we'd have an economy that can withstand rate hikes. And that's what what policymakers are looking for.
OK, excellent preview of what to expect from Germany as we digest the French numbers. Zoe Schneeweis, thank you for that update and the detail. Staying with Germany, fierce competition from China and high energy costs. So just two of the reasons that Germany's once renowned industrial machine has stalled. Bloomberg's weekly doc takes a deep dive into the challenges the nation faces.
Europe's biggest economy has a bit of a crisis on its hands.
The economic model is not working anymore.
Germany was the largest exporting nation on the planet.
And now it very much isn't.
Big companies announce restructuring programs, closing factories, closing plants, laying off workers.
Now, historically, Germany's economic story was one of almost uninterrupted growth. But that changed in recent years, when a post-pandemic rebound turned into a contraction, and the economy began to stagnate.
There is little doubt that the German industry, especially the energy-intensive sector, has been in crisis for years.
And the effects are reaching jobs and industrial communities. Economic anxiety is also pressuring politicians. So what's behind Germany's industrial crisis? And why do some experts think it's running out of time to fix it?
It's a moment in history. When you don't act now, Europe or Germany might be as well a huge open-air museum.
Well, subscribers can watch that documentary in full right now on the terminal and at Bloomberg.com.
So about Italian banking. Let me just show you some share prices just to give you an idea of what is going on. What we are seeing this morning is Paschi basically looking to become indigestible. By buying two of its biggest rivals, it hopes that it will not be taken over by Intesa Sanpaolo. This is the reaction that we're getting in the market this morning. So Paschi at the top is looking to take over BPM and Generali in one big swoop. The idea is that it becomes big enough, indigestible enough, that it will not be able to be taken over by Intesa Sanpaolo. So essentially, this is what a kind of offense move looks like. I go on the offense to be defensive. Now, the share prices are reacting in some fairly interesting ways here, which I think is fascinating. Basically, Paschi offering to buy these two banks for a combined price of 34 billion euros. Let's bring in our Southern Europe managing editor, Tommaso Ebhardt, to talk about the share price reaction and what we are seeing here. Tommaso, any surprise in the reaction this morning we're seeing in the market?
Sì, buongiorno Guy. I think how you introduce the story is quite accurate. So essentially, Monte dei Paschi CEO Luigi Lovaglio doesn't want to be taken over by Intesa because Intesa plan envisages somehow dismantling Monte dei Paschi. Intesa will sell half of the branches to Banca Popolare dell'Emilia Romagna, will keep the other half of the branches. So Luigi Lovaglio, who managed to do an incredible turnaround of Monte dei Paschi di Siena, went on the offensive and presented an alternative plan. He wants to buy Banco, BPM and Banca Generali. The Banca Generali is essentially the wealth manager of Assicurazioni Generali. It's a bold move for sure. shares reaction somehow shows this is a bold move, I would say. Lovaglio is speaking to investor as we speak at the moment, and he said these are two separate but it's one vision. We want to create Italy's third largest bank to be competitive in the market. That's what he's trying to do.
I do wonder, what's the likelihood that this is successful?
So let me give you somehow some details on what Monte dei Paschi needs to do to already start the bid. So Monte dei Paschi at the moment is under a so-called passivity rule because Intesa Sanpaolo made a bid to buy Monte dei Paschi. So they need first to get an approval by 2/3 of its investor to go ahead with the bid, and it is not going to be easy. Then to buy Banca Generali, they need to get on board Generali, which owns 51% of Banca Generali, and to buy Banco BPM, they need to get on board Crédit Agricole, which owns about 30% of Banco BPM. So yes, it's a bold move. Is this a long shot? We don't know. We have seen Lovaglio being able to do deals which were considered unthinkable, like when he bought Mediobanca, which was bigger than Monte dei Paschi, or when a few months ago he was re-elected as CEO of Monte dei Paschi despite the board ousted him. So we need to give him some credit and see how it goes.
Tommaso, there's a shareholder meeting, I believe, coming up in, October? I mean, what is the biggest roadblock or potential hurdle, I should say, to getting this deal across the line? You outlined a number of them there, whether it's the French holder of 30% or it's the shareholders themselves. What for you is the potentially biggest sticking point?
So there are several hurdles. At the end of the day, investors will decide they prefer Intesa bid for Monte dei Paschi or they prefer Monte dei Paschi bidding for other banks. Lovaglio added one element. There is a 4 billion extra dividend in cash and Generali shares, which might be appealing. But the first hurdle for Lovaglio is getting an approval by its own shareholders, and he needs 2/3 of the shareholders to approve the deal. So will be crucial what the Del Vecchio, the billionaire family, will do, what Caltagirone, the other billionaire who owns 10% of Banca Monte dei Paschi, will do in the vote. What we can say is that we heard that the decision yesterday by the board was approved by a majority of the board members, but some board members voted against it. So this shows that it's a difficult deal to be carried on, but you know, we'll see. We're in Italy. We have seen happening the unexpected, so we are here to monitor and to report about it.
Yes, and we're fortunate that we have you on the ground to follow this story in its complexity, but to give us that clarity in terms of what to watch for going ahead. Bloomberg's Tommaso Ebhardt, thank you very much indeed, joining us out of Milan. So, some potential consolidation in the Italian banking sector, maybe broader ramifications for the European banking space as well, if indeed they get across some of those hurdles. Coming up, back to geopolitics. As volatile geopolitics puts pressure on freedom of navigation, we're going to discuss the latest from the shipping industry with the Secretary General of the International Maritime Organization. That conversation is coming up next. This is Bloomberg. Welcome back. This is the Opening Trade. We're 30 minutes into today's session. A moderately and modestly brighter session for European stocks after 7 days of losses. Quite the run, almost an historic run. If we end up in negative territory, the longest run of losses for European stocks since around 2016. We're checking in on euro-dollar right now because we're getting some macro data breaking. Germany PMIs. We've got the French data now. Germany August composite PMI falling to 51. The forecast has been for 51.3, so not too far off that forecast. So that's the composite number on PMI out of Germany, still of course in expansionary territory above that line of 50. Euro dollar currently at 116, closing on 117. Not a lot of movement on the back of that guy.
It's interesting, it's the services number where we're seeing the weakness, down to 48.5. That's interesting, a reversal of what we've seen maybe over in France. In terms of the story coming out of European equities, we are waiting with bated breath to see whether or not we finish the session in positive territory. At the moment, actually, it looks okay. Volume's still a little bit light, but we're basically 2 for 1 in terms of the upside versus the downside. 392 up, 190 down is what we're looking in terms of the market internals. NIBE is out with numbers this morning. Q2 sales beat. Antofagasta is up as well. We're watching it rise. And the one I want to finish on here in terms of the winners is Paschi, up by 0.6%, despite launching that audacious bid to take over two of its biggest rivals. Banco Generali, though, at the other end of the spectrum, interesting enough, you would have thought being a takeover target would be up, but it isn't. It's down by 3.23%. You've got Eventim, which is in the event space, down by 4.9% today on the back of earnings, and a little bit of a pullback in the pharma sector today. GlaxoSmithKline, GSK, down by 1.7%, Tom.
OK, here's what else you need to know this Friday morning. Treasury Secretary Scott Bessent says he is prepared to expand efforts to buy back costlier debt. He also said the Trump administration will unveil a new fiscal initiative to address the highest borrowing costs in years. Bloomberg, meanwhile, has learned that Anthropic expects to match or beat the size of SpaceX's record-setting IPO. The Claude developer is running the numbers as it prepares to file publicly for its potential initial public offering as soon as the end of this month. Oil is headed for a weekly gain due to a US push to isolate Iran's economy, which raised the spectre of further market disruption. Treasury Secretary Scott Bessent saying the administration would give details of the initiative on Monday after President Donald Trump described the push as a, quote, economic D-Day. The measures will target Tehran and could also ensnare countries that deal with the Islamic Republic, possibly including China. Guy.
Tom, thank you very much indeed. OK, freedom of navigation. Let's talk about that. Freedom of navigation through the crucial Straits of Hormuz continues to be constrained. We know that. With the US and Iran, stalemate in terms of where we go with that waterway. Here to discuss what the implications of this are in terms of the global shipping story is Arsenio Dominguez. He is the Secretary General of the International Maritime Organization. Secretary General, good morning, and thank you for your time. I've got a letter here that is dated Monday, the 3rd of August. It's addressed to the UN Secretary General and to you, and it comes from 8 of the maritime trade organizations, basically, which encompasses basically the bulk of global shipping. And I just want to read something from the 3rd paragraph, which I think is interesting. Introducing compulsory charges for transit or service fees that are a toll in all but name through the Strait of Hormuz would represent a significant departure from established international practice. Once such a precedent is established, it becomes increasingly difficult to resist similar measures elsewhere, creating uncertainty for international shipping and global commerce. Mr. Secretary General, what can you do about this? This letter is addressed to you, but I'm wondering what legal powers you currently have at the IMO to prevent this happening.
This letter, it's actually in support of the latest decision of the IMO Council in July, where the 176 member states of IMO agreed to issue a resolution reiterating the right of freedom of navigation, compliance with international law, and in particular that no tolls or fees would actually be welcome in relation to straits used for international navigation. The fact that the member states of IMO have agreed to that, and they have the ones that have the power to implement these instruments, just reiterates that it's not only the countries, but it's also the industry, those who represent the bulk of the sector, that would also be upholding this.
The problem with that is that we find ourselves in a situation where that is not going to be the reality on the ground. And you could talk about this and talk about the fact that the industry and many countries are behind the idea that there will not be tolls, there will not be tariffs. But the reality on the ground increasingly looks like that is the direction that we are heading in. Is that just the new reality, that there is actually very little that you, these 8 global trade organizations, maritime trade organizations, can do about it? Is it out of your power now to control the situation?
Not necessarily. When we look into what exactly we're facing right now, it's the ongoing conflict. And when that happens, it is difficult to implement all the rules that have been there in place and serving the shipping sector for decades, if not centuries. Now, at the same time, it is important to remember that by having these companies and these representatives from the shipping industry having a stand against it, it means that there will not be those that will contribute to these kind of measures. The fact that the member states of IMO are all behind a no-toll system and upholding international navigation is what actually lead us to continue to implement these rules as soon as these conflicts are over. And it means that it also will not be escalated in other regions. So what we need to look at is actually the fact that we are united in this. It is a reality right now with a conflict going on. It's difficult to implement not only these kind of rules, but other rules. But the negotiations continue to be open. The member states at IMO remain very much engaged. And in fact, even right now, there are conversations going on in relation to how we're going to manage in the future the Strait of Hormuz.
In July, you said that 6,000 seafarers were stranded in the Persian Gulf and it was unsafe to transit. What needs to change for the Strait of Hormuz to be safe enough for transit?
Well, the first answer is de-escalation. That's a reality. For as long as this conflict is ongoing, it's going to be difficult for us to actually return to the normal ways of operations in the Strait of Hormuz. We still have those 6,000 seafarers in around 500 vessels that have been trapped since the beginning of the conflict. And I will continue and remain steadfast in calling for the seafarers, ship owners, ship operators, and the flag states not to send any vessels through these dangerous areas. Shipping is going through a difficult and challenging situation right now because you can look even beyond the Strait of Hormuz. And right now, it is escalating in the Black Sea and the Sea of Azov, as well as in the Red Sea between the Houthis. And just yesterday, a 6th vessel has been hijacked by Somali pirates. So it is now the time that we pay attention not only in one region, but how innocent seafarers and shipping is being affected by a conflict that is now escalating. I will remain very much in support of avoiding all these conflicts. This is going to have a difficulty for the global economy and for countries in receiving the necessary goods that they have. But it's enough time now that we pay attention to shipping, that we don't use it as collateral. And if we need to move trade completely away from these routes until the countries come back down to the negotiating table and they can find the solutions to allow us to resume, we shouldn't put any innocent lives of seafarers at risk.
Despite there being safety issues around the Strait of Hormuz, there are reports that ships are still transiting through, getting oil out. Do you have an idea of what that flow looks like?
Single numbers. It's very little transit that is going through. Of course, we have to take our time in order to verify the vessels that are actually transiting and if it's true that they're transiting, because they are doing it turning off the navigation systems. And not all of them are vessels with an IMO number. Some of those are vessels that carry out, very small vessels, domestic navigations that carry out routine trades there. But we have seen also how the goods have been now transported by road, by train, in a different way in order to support this multimodal transportation. But again, it's very few vessels that are actually taking the risk and going through. Another challenge that we're facing there, where we are enhancing the verification and inspections on vessels throughout the world, is the fact that some of these vessels are the so-called shadow fleet vessels or with fraudulent registries. And of course, those are scrupulous ship owners that are not complying with any of the IMO rules. Most of those are the ones that we've seen now being the case of detentions of hijack by pirates off the coast of Somalia and the Gulf of Aden.
Which is another complexity, isn't it, and another dynamic to deal with. President Trump has said that the Strait of Hormuz is open and operating, and that water mines in the Strait have either been removed or detonated. Either of those statements true?
there has not been any confirmation that the mines have been removed. When the agreement was signed, the memorandum of understanding between the United States and Iran, Iran took the responsibility there that they will demine the Strait of Hormuz, particularly the traffic separation scheme. But the reality is that there's still no confirmation that has been the case. At the same time, it is clear by the very single number of vessels transiting the Strait of Hormuz that it is not open. Because the reason for me to say that the Strait of Hormuz is not safe for navigation is because for as long as the threat of any vessel being attacked by any country, either the one that is holding a blockade on the Iranian ports or Iran attacking the vessels, it means that there's no ships that should be transiting the Strait of Hormuz. We cannot just resume to normal operations by making statements. From the IMO perspective and from my perspective, until we have confirmation of demining and security that the vessels, and in particular the seafarers, are not going to be attacked, I will not call for anyone operating in the area to even take the risk to transit.
Arsenio, thank you very much indeed. Secretary General Arsenio Dominguez, Secretary General of the International Maritime Organization. Really appreciate your time this morning, giving additional details about what is going on in the Strait and what is needed to relieve the pressure, of course, on maritime trade. Guy.
OK, I'm not sure how I'm going to pivot from one of these subjects to the other of these subjects. Anyway, Spiderman. Let's talk about Spiderman. Definitely this year's summer blockbuster film. We are going to talk next to the CEO of Cinema Chain View about what could be the best summer for the industry since 2019. That conversation is up next. This is Bloomberg.
What is happening to me? Did you miss me, Spidey? I'm losing my mind. I am totally out of control.
...2026 shaping up to be cinema's best performing year since the COVID pandemic. Global ticket sales have increased 15% from a year earlier, on pace for their best annual total since 2019. Here's the Sony Motion Picture CEO on the industry's comeback.
Reports of the movie business's death were greatly exaggerated. We went through COVID, an impossible circumstance. Then we went through a terrible strike, which was extremely destructive. And really compromised the amount and the variety of product that was in the theaters. And now it's back. There's great product. And I think the thing that's really encouraging about it is that young people are going back to the movies.
Well, let's get another view on this and bring in the CEO of View Cinemas. That's terrible, wasn't it? Tim Richards. Tim, thank you for your time. So we're seeing a resurgence in demand for the cinema. You guys are probably benefiting. How much demand are you seeing? What's driving it? Is it going to be sustained, do you think?
Well, I mean, absolutely. I mean, since the pandemic, and as Tom Rothman mentioned, the horrific strikes as well, which were really badly timed. We've had a supply issue, not a demand issue. We've been setting records now for the last 5 years. We just haven't had enough movies. And as Tom had mentioned in an interview several weeks ago, we were down 25% last year movies. And there was a direct relationship between box office and movies. And box office, not coincidentally, was also down 25%. What we're seeing this year is we're seeing all the movies in the post-strike period now hitting our screens. But we're also seeing the studios and content makers producing and releasing movies at unprecedented levels. And we've seen it this year. And it's not just the big movies, the tentpole movies, it's all movies of all genres of films. But this summer has got to be absolutely going to be back towards 2019 levels. And it's really 3 big movies. And they've all passed $1 billion now. Starting with Toy Story 5. Toy Story really proved that there is not franchise fatigue, and it just showed what you can do with a great story. Odyssey has broken more records than I can even count. And it's certainly Chris Nolan's biggest, most commercial film ever. It's well over $1 billion now. And then Spider-Man came, and Spider-Man is a franchise film. It's a superhero film. All the kind of qualities that everybody had written off, and it has now joined a very exclusive club of over $2 billion, and it's still going.
Tim, good morning. It's Guy. Are more people going to the cinema, or are the people that are going to the cinema paying more for a premium product?
No, I mean we're seeing certainly internationally we're seeing record numbers now. I mean we were delivering 3 million customers a week. Put that in proportion, that is 3 times as many passengers as British Airways would do in a given week. And what's really encouraging, and again, as Tom Rothman said, young people have returned. And when you pick through who is actually returning, we're seeing a 30 or 40% increase. And this is a global phenomena. A 30 to 40% increase of Gen Z. They are coming, and this is from all the studies that have been done, they are coming for social reasons. This is the generation that suffered the most during lockdown. They want to go out and do something with their friends, and they're very, very social. The millennials are also back at record-breaking numbers, and they're back for different reasons. They're back for escapism, which may be kind of a sign of the time that we live in right now. But young people are definitely back, and what's so encouraging about that is the future of our industry.
Speaking of premium products, IMAX generated something like 20% of the gross for the Odyssey, despite being only 1% of theaters. What does that tell you about where theater is going, or cinema generally?
Well, I think there's certainly a demand for a premium products, and certainly the Odyssey and Chris Nolan, and this is an unprecedented movie. It is the only movie that has ever been shot fully with an IMAX camera, and because of the size and how cumbersome they are, you can only shoot for literally 2 minutes at a time. I don't think you're going to see that repeated, or certainly not repeated very often. And you're seeing PLFs, premium large format screens of all kind, gross disproportionate amounts. And certainly we have invested in our own premium large format screen, the Epic screen that we're calling it, which has kind of the latest state-of-the-art equipment in it. And for the last 12 months, we've been outgrossing IMAX by around 20% on a per-screen basis.
Tim, can we just talk about what's happening on the supply side? You've mentioned the supply side in terms of the amount of movies that are coming out, but we've also got consolidation happening as well. Paramount's Warner Brothers obviously looks like it's going through now. That's good. That's consolidation. Does that consolidation signal further down the road higher ticket prices? Does it become a kind of seller's market, and ultimately that gets fed through into higher ticket prices further down the road?
No, I mean, certainly the commitment that filmmakers have made to feature film production is absolutely unprecedented, certainly in my 35 years in the industry. The legacy studios now, Paramount, Warner Brothers, Disney, they are producing films at an unprecedented level. Then they are being joined by the tech industry, and if anyone had any doubt about the future of our industry, you look at what the tech industry have done and their belief in our business. Jeff Bezos with Amazon loved the industry so much, he bought MGM Studios, and he is spending $1 billion now opening and hiring the best talent around the world to release his movies on our screens. Apple are a little bit behind, but after the incredible success of F1 last year, they're the ones to really keep an eye on. And then you look at what happened with certainly Oracle, with David Ellison and his father Larry Ellison supporting him financially. They've come in, and before Warner Brothers was even on the horizon, they came in, purchased Paramount that had a run rate of around 7 or 8 movies a year, and they took that to 15 movies this year. So when the acquisition of Warner Brothers came up, people in the industry believe them because they already had a track record of delivering that. Okay. So when David Ellison says, I'm going to do 30 movies, he believes it.
Okay, and the theatrical window all of them seem committed to it as well. Tim, nice to see you. Thanks for joining us. Tim Richards, the CEO of View, the cinema chain. We've got a great product coming up as well of our own. Bloomberg Screen Time. The event is coming up, gathering leaders, defining the next phase of pop culture, September the 30th. You've got conversations with, like, Ben Affleck's going to be there. Walt Disney president's going to be there. Dana Walden. Plenty coming up at that event. Must see.
Let's turn back to the markets right now with Adam Linton from our Markets Live team, our very own Ben Affleck. Let's start on the macro data. What do you make of the PMIs? Do they change your view on the economy of Europe and how markets should be reacting to them?
Not really, no. I mean, I think the France one was weak, but going forward, France is going to carry a lot of its own idiosyncrasies. We've got the budget negotiations coming up. We've got the election next year. I think it was interesting in digging into it that service inflation, that's been guided by higher oil prices. It's interesting to see if that's reflected elsewhere. Then for Germany, solid manufacturing, but can that be sustained? I think for the ECB, September's pretty much locked in, and as such, we've not really seen much movement in European assets.
I mean, we've had quite a busy week for an August. We've got buybacks, we've had European equities under more pressure as oil prices have risen. And what really stands out for you in terms of something that can go into the months ahead?
Yeah, I think that the key kind of top-line summary for this week has been that US policy uncertainty is a key driver of cross-asset moves now and really serving to undermine the dollar. I mean, the dollar's been on the back foot for a few weeks now. We saw the July FOMC. That really undermined the dollar, with Walsh kind of unable to describe his plan he had to kind of get inflation back towards target. And so the dollar further undermined by policy uncertainty this week with a buyback. And obviously the buyback, that's obviously relevant for the bond space. We're seeing the US administration trying to restore some order at the back end of the curve, but it's kind of fallen flat on its face at the moment and could serve to undermine what we're seeing in the bond market, as it doesn't really address any of the structural issues we've been discussing this week, such as deficits, competition from hyperscaler capex. And then for Europe, it's still just an oil story. You know, we're seeing that further along the curve, and it's now weighing on European equities.
Adam, thank you very much indeed. Have a great weekend. Thanks. Adam Linton from the M Live team. Talking the weekend, got some F1 this weekend. Yep. Arsenal play tonight.
Arsenal play in Coventry.
The Prem starts.
8 p.m. At the Emirates. So the Premiership starts. You got the Grand Prix in the Netherlands.
Yes, that's coming up. And Skylar's going north to watch the Odyssey.
Yeah, absolutely. I'm going to sit in a very comfortable chair.
Yeah. This is the thing. People want to sit in comfortable chairs at cinemas now.
We've been sitting in our comfortable chairs as Skylar has given her analysis on what's happening this week with the bond market so squarely in focus. It's been fantastic to have Skylar with that deep dive and with those insights, because Skylar is going to be, sadly, at least for now, going back to her day job next week, which means a later start, presumably.
Yes.
And absolutely, and I do have Monday off.
And you have Monday off as well. Even better. Wow, I'm really jealous now. That wraps things up. It's been an incredible week. Watch the close today for Europe. If we close negatively today, that will be the longest run of losing equity market performances we've seen back-to-back for 10 years, back to 2016. Anyway, that wraps things up. Have a great weekend, folks. We will see you bright and early on Monday morning. The Pulse is up next. This is Bloomberg.